Right, 8:30 sharp and time again for Boutiques on Wednesdays. Good morning to our wonderful audience. Always great to have you on these sessions. SA equity valuations still look attractive relative to global developed markets, but investors are truly running scared with SA plunged into darkness. Little to no economic reform and the amount of shares drying up on the JSE and continued political shenanigans as always. GAN clients still make decent returns from SA equity, which is still a big part of our clients' portfolios. Joining us here today and here to introduce and lead a panel discussion on SA equity is Brendan de Jong, SA Head of Research at Portfolio Metrics. Brendan, thank you so much for joining us. It's really great to have you with us this morning, and thank you for the time. For the audience out there, we all know by now that Portfolio Metrics is a well-established DFM in South Africa. But Brendan, I mean, your business truly grew into a true global investment management company over the past 13 years, with office not only in South Africa, but also London, Dublin, and California. It's really great to see how that business progressed. And again, thank you for your time. We're really looking forward to your panel discussion on SA equity and see what there is to offer. Brendan, I believe you're going to introduce the panel.
Fantastic. Thank you very much, Eugene. And thank you very much for the fantastic introduction. Yeah, we joined here by a really powerhouse panel, and quite a large panel too, so hopefully I can keep the conversation going. First up, we got Evan Walker from 361 Asset Management. Peter Armitage, CEO of Anchor Capital, Chris Reddy, Portfolio Manager and Equity Analyst from All Weather Capital, Patrice Moyal from Visio Capital, who's Chief Investment Officer and Director. And then last but not least is Barry Shamley from Investec, who's a fund manager. So guys, thank you very much for joining us. I think we've got really a lot of topics to cover here. It's been, as Eugene mentioned, a very difficult time for South Africa, and it seems to only be increasing pressure. But I think before I actually move into the nitty-gritties of global issues and also local issues, I'd actually just like to quickly start off with more of a theoretical kind of question. Now, I know I'm fully aware that all the panelists here are South African equity managers, and you have South African equity portfolios, and some of you may have a more broader mandate as well, where you're able to take around 45% in global equities along with the SA equities. But first up, and I think, Peter, I'd like to ask you this question. If you were to have actually a fully global equity mandate and there were no sort of constraints as to where you needed to invest regionally, would you have any South African equity exposure right now?
I think the way we would look at it is on an individual bottom-up share perspective. So I think there are some shares on the South African market, and this year particularly those that are not related to SA Inc., which might find their way into a global portfolio. You know, the likes of Naspers, Glencore, Richemont, etc. So I don't think we'd be looking at it saying we want 2 or 3 or 5 or 7%. I'm not sure what the number is in terms of our share of the MSCI World with Emerging Markets. You know, I'd imagine it's probably 1 or 2%. So we look at it from a global point of view. But I think there will be a bottom fishing time. I think there could be more chaos still to come in South Africa. And at that point in time, we might make a South African specific allocation. But I think you need to be a specialist in the SA market to make that call.
Yeah. Barry, would you agree with that?
Yeah, very much. I mean, I think there's always going to be the benefit of being based in South Africa in terms of your stock selection. But I think that, as Peter was saying, that number, I think it's less than 1%. I think it's about 0.4% in MSCI, all countries world. But I think there will be specific opportunities that you can't always access in global markets, like our platinum stocks. Sometimes our gold stocks are a bit cheaper, or maybe a story like MTN, which gives you a broader African play. But right now, it's hard to motivate for SA sort of GDP-linked plays. As Pete says, I think we're in the midst of some tough times. I think if you're big, maybe start time to sort of putting your toe in the water. But you're small and nimble, I think you've got a bit of time.
Sure. Okay, fine. So we'll move on from there. I mean, South Africa has its own idiosyncratic issues, but also on a global basis, there's quite a lot of stress in the markets. I mean, we have inflation that seems to be stickier. We've sort of going through, or still going through, interest rate rises globally. We have geopolitical issues, et cetera, et cetera. So the global macro environment is quite a difficult space at the moment. And I guess, Evan, my question for you is, given these kind of elevated risks globally, and we've also seen kind of foreigners not necessarily taking a liking to South African equities. I mean, what does that mean for us? I mean, how have these flows kind of affected South African equity markets, given sort of the broader macro environment, and what has that meant for sort of the performance for different segments in the South African equity market?
Thanks, Brendan. Yeah, as we know, the previous speaker said it's been tough out there. Our view is really we are starting to reach a peak of global goods inflation. I mean, we've seen freight rates come down from $14,000 to $1,350. We're still sitting with high global food inflation, and that's a big issue for South African consumers currently. We saw Tiger Brands yesterday up with inflation of 16-17%, a big number getting passed through on the South African side. And obviously this Rand blowout, causes obviously related to Eskom, and then political causes, as we've seen Ramaphosa's, stumbling around the Putin issues, etc. I mean, and potential sanctions coming to the market if Putin arrives here in August. So, not looking good for us. And then the Chinese market obviously stumbling out the blocks here. They're really starting to get a handle. I mean, they were hit very badly last year by lockdowns, and I think more extensively by a significant decrease in their property sector, and now fueled by sort of a global slump in demand for goods, specifically export goods out of China. So, a triple hit to them. What do we think happens here? We do think markets begin to stabilize fourth quarter into first quarter next year. Rates do start peaking by the end of the year, start to drift lower into first, second quarter next year. But it's a tough 12 months still, guys. I mean, we've got global rates around the world still rising. I think we're nearly at the peak of global rates. Certainly from a distress point of view, I think we need to be there. So we're not far off. And I think if you're a global manager now, you need to start looking at deploying third, fourth quarter into potential rate declines in 2024. If you sit too far behind the curve, you're going to miss it. On the South African side, I think we've got a bit more time. We've got this pass-through effect, and we are starting to nibble. No doubt, I mean, valuations are looking attractive, but it's also going to be a 24-month story.
Okay, so I mean, South African equity markets South Africa in general is a small, open economy, heavily commodity driven. So we kind of are at the mercy of global forces. Patrice, I think I just want to ask you, again, probably more of a theoretical question, but in terms of top-down analysis, how important is that for you in kind of your process and how you think about portfolio construction in your portfolios? And has that kind of become more of an input into the process over the last 5 years?
Yeah, it's a good question. It definitely has, unfortunately. So the things we can't control, we've had to get a better handle on. So all these macro issues. And so it's not so much bottom up anymore, but you've actually got to secure some kind of comfort from a top down perspective. And the macro factors are so overwhelming that you're bound to make a lot of mistakes along the way. So try and keep it simple. As Evan said, commodities, or you said commodities is a big theme in South Africa. So thankfully, we've got some tools there in BHP and Glencore and South 32, etc. And then notwithstanding the poor news on China, the Richemonts and the LVMHs are doing a roaring trade. So you've got to actually be quite selective and in not completely dismissing China altogether, because then Richemont would not be such a great performer. So you've got to be really, really careful and nimble, and don't overstep. Don't get too ahead of yourself. So don't try and be a hero in any particular direction, because it's very likely you'll get sorted along the way. So there's no easy answer. Just be very specific in what you are targeting. I think that's really ultimately the situation. And the top bottom up is not working that well anymore, unfortunately.
So I mean, you mentioned China, and I'll move this question on to you, Chris. China is quite a big influence on our market. You've got directly Naspers process on the stock exchange, technology, China Tech. Richmond was also mentioned, global luxury goods, but high China exposure, etc. And then obviously the commodity trade. So I mean, can you just kind of break down just how important China really is to the South African market, and how you kind of look at it, and also from a stock selection perspective, how you look at China and its influence on the market itself?
Yeah, thanks, Brendan. As you mentioned, obviously the key look through on the SA market has been the Naspers Tencent holding in Naspers and Prosus holding into Tencent. I mean, I think if you look at just China reopening into the back end of last year, a couple of the trades that we looked at was the consumer-facing stocks, so the tech stocks, the resources play coming through in iron ore, coal demand, and some of our PGMs, mainly as a read-through into the vehicle segment. And then the last thing was just around what we're seeing around gambling demand, luxury sector demand as well. I mean, I think if you look at all three themes there, the only one that's actually held up quite well over this period has been the luxury segment. So the Chinese opening up trade has offset some of the weakness that we've seen coming through out of the US consumer. We haven't seen Chinese tourists traveling into Europe, which has been a bit of a disappointment, but expectations are that once those visas are lifted, you'll start seeing Chinese consumers going into Europe. I think from an SA point of view, I mean, I think the immediate read-through is what we're seeing in the discount to Naspers and Prosus, given their holdings in Tencent. So that unfortunately that discount has widened of late, given what's happening with the share prices. So that's the key factor for us. From a trade perspective, you mentioned already that it's our largest trade partner outside of the EU bloc as a whole. So it is a key factor in terms of our exports. I mean, unfortunately, some of the challenges that we've had from a coal perspective hasn't helped with regards to volumes from Thungela going into Asia, for example. But I mean, we are seeing some green shoots in terms of how that coal line is operating. So hopefully that helps us from a fiscus point of view. And then on iron ore, I mean, the one factor that hasn't come through, unfortunately, has been infrastructure spend in China. I mean, I think there's always talk around some of these ghost cities that have been built. What does that mean for iron ore and steel demand going forward? And what we are seeing is some softness in the iron ore price at the moment, maybe because of limited infrastructure spend coming from China. So that's not that positive for the likes of Kumba and then read through into Anglo-American. So I mean, the way we're looking at it is you can play iron ore via some of the small to mid-cap shares. Afrimat, for example, also has high quality iron ore, but you're also getting diversity in their coal operations, for example. And if you look at something like Afrimat versus Kumba, a large portion of their contracts are at fixed prices, so that you actually reduce some of the volatility in the commodities exposure. So going to what Patrice was saying, I mean, it does come down to stock selection within each of the various sectors that you've got to view.
So I'd just like to stick with you, Chris, because having a look at some of the fund fact sheets and holdings of portfolios, it seemed like you had almost zero in technology exposure, which is Naspers Prosus. Please correct me if I'm wrong. I think it was the April fund fact sheets. Now, I mean, given the size of that sort of Tencent stable, it's quite on the equity market, it's quite a sizable relative call. Can you kind of take us through that bottom up kind of decision there?
Yeah, so I mean, I think in terms of how we've invested in Naspers and Prosus, I mean, a lot of it has been driven by the discount that we saw from a sum of the parts valuation. So over time, we have taken profits on that trade, and subsequently we have actually put on the stable again in our funds. So if you look at the most recent set of numbers, you will see Naspers and Prosus in the funds fact sheet. I think if you look at probably beginning of last year, first quarter of last year, where the discount widened significantly in Naspers and Prosus into Tencent, it was one of our highest conviction calls. We subsequently took profits towards the latter half of the year, and then we've added it back on now, given the significant de-rating that we've seen both in Chinese equities and then similarly on the discount widening in Naspers and Prosus. Look, I think a large chunk of the the argument as well in Naspers and Prosus has been the significant buyback that Naspers and Prosus have been doing. We do expect that to continue. There are a couple of regulatory requirements that need to be cleared from a national treasury point of view, but we think that that is going to be approved. And then I think the next argument on this table is going to be the next step in terms of the consolidation of the structure, which I think most managers are looking forward to latter half of this year, early next year.
Evan, a lot was said about the kind of China reopening trade, and that doesn't seem to have materialized to the extent that people were hoping. What is your kind of take around that?
I think there was too much optimism built in originally. I mean, Brendan, if you look at Chinese GDP, I mean, it's still reliant, 25% of GDP is still reliant purely on property. And I mean, that property sector was decimated in that fallout that we saw 21 into 22. There's still, over $2-3 trillion worth of refinance that has to go into that sector. And, the government is trying to hold up, sector which has been tough. So, I think the starting point there is that was coming off a huge base. That needs to reset itself. I mean, they were building circa 15-20 million new homes a year. We've really seen a huge amount of, new cities developed, as Chris already said, etc. So, there's been a lot of heavy lifting, from the industrial side, etc. And obviously, from a GDFI point of view, China's done whatever they can in electrification, etc. But I mean, that's really small or smallish in context to this housing market. So I think starting point is China obviously hit with significant amount of lockdowns. Consumer sentiment is obviously at near-time lows. And then, off the back of this in the property sector, obviously seeing the rhetoric around geopolitical tensions and onshoring back to the US, seen Apple move, etc. I mean, these Chinese aren't stupid. I mean, obviously jobs are at risk in China. So I think it's going to take time. I mean, you need sentiment in China to improve. We don't think it's all fall down. It's a huge consumer economy. It'll come back, as Patrice rightly said. Sector of the market is doing well. Retail still up 10%. Vehicle sales are still up year on year. So, it's on an all-time collapse. I mean, it's just, big sectors that have had big weightings. The GDP growth numbers just need to come back. It doesn't take, you don't flick a switch, Brendan. I mean, it takes time. We think there'll be more stimulus into the market, third, fourth quarter. Inflation's not an issue in China. Inflation's benign. They can cut rates further. I think they don't want to overstimulate the economy. I mean, they're probably overstimulated in the past. So it really needs to transition now. Growth will probably be nowhere near the 5% level that GDP and economists are looking for globally. So I think it's going to be fine. I think it's just going to take time to come through. But the global economy needs to pick up again. It's going through doldrums currently, and China obviously sees the benefit of additional exports coming through their market as well. So it's a synchronized play globally, and China's not going to decouple. We saw that in 2008. It didn't decouple from the rest of the world like everyone thought it would, and it won't again. But it'll take time.
Okay, great. I'd like to move on to you, Barry, and just a very quick response to this. But I guess we've been seeing almost globally a lot of public companies going private, or private companies not necessarily wanting to list. But South Africa has been very much a part of that trend, and we've seen a lot of delistings certainly since 2011, 2012, and it's kind of accelerated in the last 6 years. Very quickly, I mean, would you see that as a risk or an opportunity as an active investor in the market space?
I think it's certainly an opportunity. I think there are maybe different reasons for the delistings or the companies remaining private. I think globally it's been cheap or easy money. There's been a lot of move into private equity assets, and basically because you can keep on valuing them at whatever you want to value them at. So, I mean, particularly on the JSE, we were able to pick up companies often trading at much lower multiples than what private equity were paying for those companies in the private space. I do think, though, it's part of a long-term trend, and I think EM has been in a bear phase for probably at least 10 years. And I think as we pull out of this, as emerging markets enter a new bull phase, I think we will come back into an era of new listings as new opportunities come to market. But as it stands right now, I think there still are opportunities when companies are taken private to participate in that short-term upside, despite the fact that our sort of opportunity set's getting smaller.
Okay, perfect. Okay, so I want to move a little bit more locally specific, and there's really a lot going on, Peter. I mean, load shedding has been sort of on the agenda since 2008, but it's really come to a head, and a lot has been said about us going into this winter and the kinds of risks. I mean, from your perspective, what are you seeing in the short to medium term as the risks to first of all, the economy, and then also what that means for South African businesses?
Yeah, I mean, it basically just is a stranglehold for the South African economy. So I think, everybody's just trying to hold on to volumes, try and adapt to their business specific interests. There's certain companies that, can do something about it. I think you're going to see, I think we're providing 25 to 30 gigs of power at the moment from Eskom, and demand is sitting at between 28 and 33. The private sector, I think, will bring on kind of 10 to 20 gigs over the next 3 to 5 years. So the real issue is the next 12 months. And I think everybody is so negative and so pessimistic that I don't think anybody thinks that load shedding will end in the next 5 years. I think that's too pessimistic, but I think the next 12 months will be a bit of a horror story. I think a continuation of what we're experiencing at the moment. You're seeing a very real impact in terms of diesel costs coming through for companies. Company like Pick n Pay, it's eating up about 20 to 30% of their profit. They sit at a low operating margin, so differing impacts across the board. But it's the future from an SA point of view. It's the only bright hope is if the government allows the private sector to take over the provision of lots of services. And our private sector is amongst the best in the world and will adapt to that and feed through quite quickly. But it's, the next 12 months for SA Inc. type shares in the SA economy, things look pretty dire. I think you do tend to have more electricity supply during winter. So there has been a lot of maintenance done in the summer months. So I think it's going to be bad, but maybe not quite as bad as what people are expecting.
Patrice, I'd like to sort of move on to kind of companies that are directly affected in terms of food security, etc., needing to cool or keep food cool. As I'm talking about ShopRite, the Woolworths and Pick n Pays and so on and so forth, and moving into like a stage 8 and perhaps even sort of a more serious load shedding kind of situation. What are those businesses saying to you in terms of their preparedness for something like that under a scenario like that?
Well, I think to Peter's point, I think they're preparing you for the worst case, and then hopefully it doesn't get there. But I think every company's in the same boat. ShopRite's probably better because their margins are 2.5 times those of Pick n Pay. SPAR relies on its franchisees, so it's almost out of their control, unfortunately. If the franchisee can't expend the money to put in his own generation capacity or backup, he's going to have issues, and unfortunately SPAR will be at the mercy of their franchisees. They may have to waive some form of payments to allow some capex to go ahead. So it's a very difficult situation just in the main for these big food retailers. So at best for now, I think to Peter's point, let's just don't expose your funds to these types of risks until there's some clarity. And we're not electricians. I think Eskom's problems are way deeper. We unfortunately relying on diesel. I think we're going to be relying on a lot more diesel. You can't replace power stations that are 30 to 40 years old in the space of a couple of years. And just remember, solar power, when you're told you're putting 2 gigs down, essentially it's only 30% efficient because there's got to be sunshine, there's got to be, it's only going to give you roughly 30% of that so-called nameplate capacity. So you could get up to 2 gigawatts or maybe half of that if you could store it anyway. And then we don't have storage capacity. And then there's also the transmission issue. So we are far less bullish that we're going to see a resolution to electricity. The shortage is upwards of 10 gigawatts. That's essentially two Kusiles, and they're not even working properly. So 2 Medupis is the same thing. They're 4,800. They're 4.8 gigawatts if they were working properly, but they're not even working properly. So we see deeper issues. The private sector will have to fend for itself, and otherwise find the companies that aren't really that affected. So education, carries on. You don't need to cool down food in schools. You saw yesterday, Pepcor's got 75% of their stores that are kind of backup power now. So these are the types, and then the hospital groups are in a difficult space regulatory wise, but they've got essentially backup. They had to have that backup a long time ago to save lives. So you got to find some companies that will survive. The point is, when do you start to bottom fish? And unfortunately, the bad stuff is dragging down the good stuff too. So it's a very tricky environment right now.
Yeah.
Load shedding or low load shedding. Some companies aren't affected essentially.
Evan, can you give me kind of an idea of what the risks are to the fiscus? I mean, we've got a low growth environment, load shedding is extremely inflationary, etc. What do you see over there? What does it mean for SA equity investors and just the discount rate? I mean, to SA equities, what does it mean?
Yeah, Brendan, I think this is a big issue that hasn't been discussed yet. I mean, we started to look at what economists are forecasting. I mean, we've seen Morgan Stanley come out now with, 4.6% debt to GDP for next year. And we run some sort of provisional forecasts and think it could be higher. It's a double whammy for the fiscus now. I mean, obviously it's very beneficial for the private sector to put in this generation capacity, but they're getting 125% deduction on that. So, a couple of 100 million off the fiscus a year, 100 billion, I should say, off the fiscus every year is going to come their way, just in terms of these deductions to start with. And then, it's a bloodbath out there. I mean, in terms of actual, our platinum sectors we think in structural demise over the next 3 to 5 years, given the rollout of EVs. It's a huge taxpaying component that was in the base. And then obviously we think VAT receipts are going to come under huge pressure now. It's just you're seeing, high food inflation, but other discretionary incomes come plummeting down. And our terms of trade actually has to improve, which means that imports have to dry up. And it's going to have a big effect on our VAT base. So we actually started to get more and more nervous around just funding this deficit into 24, 25. We think this could be a much bigger number than what Treasury is estimating. And, that's the second round effects that we're worried about now. It's not so much anymore just generation. I think that'll come, like Peter said. I'm sort of more in the Patrice camp. It's going to take 3 to 5 years. It's not a 12-month effect. It's a sort of 36-month effect just to stabilize. I think if we see some stability over 12 months, like Peter said, we'll start to get maybe some nibbling back into the stock market, just as we see some stability. I think that's what people are looking for. But it's going to be a 12-month, it's going to be a bit of a bloodbath still out there. So, yeah, but I mean, I think now it's going to be a case of, the foreigners are going to pay a lot of attention to our fiscus, to our bond market, to where the rand drifts off. And if we see any more currency weakness come through, driven by lower commodity prices, and specifically on the platinum stocks. I mean, this is one sector we're very wary of currently. I mean, we're worried about the fiscus into 25.
All right, Chris, just staying on this kind of load shedding theme and talking around kind of grid collapse. What can you do as a long-only SA equity investor in a portfolio like this? I mean, other than going into rand hedge stocks, or are there any other kind of option trading strategies you can put in place, like a short fence or something like that? I mean, how are you looking at that? Is it a risk that you even trying to put into the portfolio?
Yeah, Brendan, good points. I mean, we had a couple of calls with Eskom and National Treasury over the past couple of days. I mean, it seems as if the likelihood of a full grid failure is very, very low. So, I mean, we might just go to significant amounts of load shedding before we get to a grid failure. And that's just the opinion of Eskom and National Treasury. Based on Eskom's latest update last week, we're most likely going to be between stages 6 and 8 throughout winter. So that is a challenge for many of our SA Inc. shares. I mean, especially the retailers and food grocers in particular. In terms of actual protection of the portfolio, I mean, depending on what your mandate allows you, we have in the past used things like put spreads. Obviously comes down to the pricing of the derivative and the level of protection that you want to get. But basically you could buy like a 95% of strike puts and then sell 85%. So you're getting about 10% downside protection in a strategy like that. Obviously, that will then protect you from a specific index. As you know, about 65 to 70% of our index is offshore focus. You're just going to be cautious in terms of what you're actually hedging, because I mean, you don't really want to be hedging the rand hedges in a scenario like that. It's not really going to be working out as planned. So quite selective in terms of which portions of the portfolio you want to protect in a scenario like that. I mean, the other way is obviously on position sizing into your SA exposed names. Patrice already mentioned that it might be a bit too early in terms of bottom picking in some of the retailers if we do get a very harsh winter. I mean, some of the risks to this view obviously is that if we have further sabotage on some of the power stations, we really don't have a big margin of safety when it comes to power production. So if the sabotage, wet coal, greater demand because, I don't know, weather conditions are not good for renewables, then we could actually have a harsher winter schedule of load shedding. But grid failure is not our base case going into this winter season.
Great. Barry, I'd like to pick up on what Evan spoke about. I mean, he kind of gave his very, very briefly his views on PGMs, but I'd like to hear your view on this. I mean, you've had platinum stocks, Impalas, etc., giving you returns, especially if you go from end of 2015 to now at compounding 30-40% per annum. It's been quite extraordinary. And yeah, Evan mentioned EVs and what that kind of could mean. I mean, what are your views on it?
Yeah, we've been through a very positive cycle for the platinum stocks and the PGM basket as a whole. I think today the whole market's quite skeptical of the PGM sector, but I think they're focusing almost solely on the weak demand conditions in China and EU, and very little on the fact that SA supply is quite seriously challenged. We think SA production, which is about 80% of world PGM supply, could fall as much as 25% this year. Which certainly doesn't help the miners, but as a hedge against SA, a platinum ETF would probably do you quite good. I mean, for example, can you imagine OPEC cutting supply by 25%, what that would do? So maybe we're not as excited about the platinum producers, but the actual physical platinum might do quite well in a scenario of high load shedding.
Okay, Peter, I'd just like to, and I see there's also actually a question here regarding what was just recently yesterday coming out from the SARB and speaking about the risks of sanctions. And we saw the rand kind of blow out sort of immediately after that, kind of discounting that in or possibility. Under that scenario, what does it look like for the South African market itself?
Yeah, so I mean, if you start getting sanctions against South Africa, we really have got into the absolute doldrums. I think the one thing is the impact on SA, and then obviously this all flows through to the impact on our market. If you got into that scenario where South Africa continues to create the perception that they're aligned with Russia, which they're saying they're not, they're saying they are a neutral party, although their behavior seems to indicate otherwise. I think it can be pretty damaging from an absolute and sentiment perspective for the SA market. In that situation, you could see more rand weakness. And, just something to remember in this whole call, you look at SA equities, if you were sitting outside of South Africa and you heard this conversation, you would have imagined the SA market would be down 20 or 25%. A lot of SA Inc. shares are. But the weakness of the rand has buoyed up the performance of a lot of other sectors in the rand sensitive sectors. And, I think the actual market for the year, I'm not sure where it ended yesterday, but it's down 3-4%. So the SA market, you really got to separate into the SA shares and the non-SA shares. So all of these really horrific scenarios are positive for one and negative for the other from a flow through point of view. But it's yeah, I mean, I'm not sure most of us are preparing our portfolios for sanctions, and South Africa, we then start to get put in the same sort of basket as a country like Turkey, which I think some far away foreign fund managers are probably starting to do already. It's certainly not our base case that you'd have sanctions, but the SARB certainly, the SARB is using its messaging tool to try and get the government to do things that work for South Africa and to try and fulfill its mandate. So it has to put out all different scenarios there. I don't think the SARB is saying that that's the expectation, but they've put out various risk matrices. explaining the different extremes from a risk point of view. But yeah, I mean, the way we're dealing with in our portfolios is to have a huge bias towards non-SA shares.
Okay. I suppose, Patrice, I'd like to touch on that. I mean, one of those really big stocks on the market, and we've spoken briefly about that, is Richemont, but there's something technical that's happening, certainly in the ALSI index, where I think in June, they're going to be using more the SWIX kind of methodology for Richemont, and that kind of means that the Richemont exposure in a benchmark like ALSI or top 40 is moving from 20-odd% to 4%. So just a purely passive implementation is going to be losing a lot of that offshore exposure, I guess. How do you view something like that in terms of possibly a trading opportunity in the portfolio? Is that anything that would kind of be on your radar? I mean, given the fact that it's probably going to be quite large volumes going through on that.
Yeah, Brendan, you're right that there's a readjustment on Richemont. It's 10% or 12% of the CAPI funds, so it's quite material. It'll do nothing to the share price essentially, because it's more volumes. The stock's share price is made in Switzerland anyway. There will be some churn. There will be some rebalancing on the last day of the month before, or the last day before it happens. But essentially, from our perspective, it just means we have slightly less need to be exposing funds up to 10-12% in one stock because it's in the benchmark. At the end of the day, it comes down to the merits. At this point, we think there's merit in still being overweight, but 2% overweight on 10 is 12%, 2% overweight on 4 is 6. It's a lot easier to stomach 6 than it is to stomach 12. So I think it's useful. It will just mean, what are we going to do with the excess cash? We'll redeploy it, and we'll redeploy it. Maybe it'll be local, maybe it'll be offshore. We'll, depending on our preferred list of shares at that point in time. It doesn't change the nature of Richemont in any way. It's just obviously a bit like when Naspers would otherwise be 30% of the index now. They had to bring it down to roughly 10 between Prosus and Naspers. So I think, look, at the end of the day, essentially, these adjustments are just technical. There's no doubt that the overweight or rand hedge exposure is benefiting, thankfully, pension funds and investors. Ideally, we'll see a few more of these as these stocks become a lot bigger in an index that's shrinking domestically.
Yeah. So, Chris, I'd like to kind of stay with the sort of more technical kind of stuff, and certainly in the South African market, it feels like the need to be nimble and being able to trade in and out of stocks is quite high. I mean, how do you view it? Are you guys finding the need to be quite active in the market is a little bit higher than what you've seen before?
Yeah, Brendan, I mean, I think the one thing that we have been watching quite closely is just the level of liquidity that we're finding in the JSE. I mean, the one key theme is that a lot of the trade these days is being driven by passive flows. So a large chunk of the trade happens in the end of day auction. For some of the top 40 shares, you're getting close to about 35-40% of the volume coming in the end of day auction. So what you find is that if there's limited liquidity in the day and there's a seller, you could see significant pressure in the first couple of hours, especially when the US and the UK is not open. So in situations like that, you could see, for example, like some of the trades that we saw in the past couple of days, when there's no buyer out there, you're getting significant selling pressure coming through in the open for investors that want to get out. Those are creating some opportunities for us. The other thing that we're closely monitoring as well is just the general positioning of domestic investors as well as foreign investors. So in a situation where an investor wants to get out of a share, you're seeing significant volume coming through in a particular share, and those are a type of cleanup opportunities that do add alpha for us if nothing fundamentally has broken on the investment case. So those type of trades are definitely on our radar, and I think it is a trading opportunity both on the buying and selling side. I mean, on the flip side, if you've got a large buyer that's looking to build up a stake in a particular share, you'll often find that would ramp the share price relative to their peers. that is potentially a selling opportunity, I think, if it's been pushed ahead of what we think is fair value. So definitely opportunities out there from the trading side.
Evan, trying to go a little bit more on the positive side here, and I mean, there's been a lot being said about green hydrogen and South Africa's kind of privileged position of having vast amounts of potential renewable resources available to us, and being able to be quite a heavy player in this space. You've also seen quite a lot of noise coming from the government in terms of trying to take an active step in this. I mean, what is the opportunity? What is green hydrogen? What is the opportunity? Is it realistic for us? Are there any companies kind of trying to set themselves up for this? I mean, what are you seeing?
Yeah, Brendan, it's a very interesting question. It's a global question. I mean, there are companies around the world that are producing green hydrogen. It really is just taking water and separating it into oxygen and hydrogen gets used in a number of capabilities. I mean, thousands of different capabilities. It can drive anything from a vehicle. Put in hydrogen, it spits out oxygen instead of obviously noxic gases, etc. So it's very positive. I've been actually quite fortunate to have quite a few discussions with Sasol's team on this whole green hydrogen issue, and they've done extensive work on it. They've come to the realization that the input cost, i.e. producing the actual electricity to separate the ingredients in hydrogen into the two capacities, is just not feasible in South Africa, just given the actual amount of capital that has to go into a project like this. It's billions and billions of rand that has to go in. And then unfortunately, the distribution capability, i.e. you need to produce the energy in one part and then ship it to another part where you produce the hydrogen, because obviously hydrogen needs to be exported, etc. So you don't want the hydrogen sitting in Springbok or the Northern Karoo or wherever. You want to make the hydrogen there, you want to make the hydrogen close to a port or a distribution network, but you need to make the energy in an area where there's high sunlight intensity, given what Patrice said. You're only really on solar, you're only getting, solar working between 11 o'clock and maybe 4 o'clock maybe in Uppington, and then maybe a little bit more in summer. So, I've had quite big discussions with Sasol. I mean, they're leading up quite a big group. They're still on the project. They're obviously still looking at it extensively, but at the onset now, it looks like these are massively capital intensive. They're still looking to potentially partner with outside investors. So, Brendan, it's not off the table yet. I think the problem for most of these guys is the distribution network in South Africa. We can actually probably do it, and we could probably get outside investors to come in and put up capital to do it, but it's all about moving the power around the country now, and the distribution network is not there, and Eskom's, whether Eskom can come to the party and actually provide that, or that gets done by another third party, will be interesting to see. I certainly think it's a long-term project. I certainly think it can still happen, but there's a lot of hurdles. There's a lot more hurdles than I initially thought in this process, and it's a very interesting process. It's fascinating, but it also comes with a lot of capital. There is global capital, and it eventually could work, but it's got a lot of hurdles.
Barry, we haven't spoken about banks yet, and I just want to move on to you. I mean, certainly given the interest rate environment, I mean, we've seen a lot of interest rate rises. It looks like we're not necessarily at the top locally at least, but what does that mean for banks? I mean, we've spoken a lot about how banks are well capitalized, well managed, etc., but given the pressure on consumers, non-performing loans, what do you see in the space? Which banks are better positioned?
I think banks are a tough one. I think they were seemed like a dead certainty about 6 months ago, but I think interest rates have pushed up higher than many have expected, and the weaker rand on the back of the drama with Lady R and the Russian ship has, I guess, pushed out those inflation expectations a little bit more. And unfortunately, the Reserve Bank, everything is a nail when all you've got is a hammer. So we worry that we are in for more. I think on the lower end side, I mean, you can see it certainly like in the Capitec results, the impact that it's having on disposable income, the amount that, for instance, your home loan repayments have gone up. You can see at Tiger Brands results how people are down trading. So I think certainly at the bottom end, consumers are very stretched. I think there are some opportunities in the renewable space. There's a lot of opportunities for banks. They're like tailwinds, opportunity to lend. But I do think things are going to be a lot tougher than what we expected 6 months ago. So we're sticking with a sort of better quality at the moment, or certainly in my mandate, FirstRand and then Investec, because you've got a bit of offshore as well there, and their client base is generally a little bit less affected, better position to deal with the higher rates in the short term.
I think we've got time for one quick question, Peter, and I'd just like to move on to, are there any companies that are actually taking advantage of this kind of environment and eking out returns for investors, and specifically something like a Bidvest that came out with results in March, and they seem to have done some things there. I mean, is there anything else, or would you like to talk more about Bidvest and what they've actually done?
Yeah, so I think there's number one is exporters. One of the saddest things and indictments in the SA market is there's hardly any industrial exporters. If you try and think through who produces stuff in SA and sends it around the world, that's largely the resource companies. So, we in our top 10, we've got a company like Afrimat, whose selling price is basically dollar denominated. Then you've got companies that like a Bidvest and a Grindrod, I guess, who are taking advantage of, they're sitting as an infrastructure play. They're sitting in the distribution channels. They're helping with the export of product. Grindrod is, because of how bad our ports and lines have been into Richards Bay, their Maputo port operations have done very well. So, you've got to look quite deep to find the companies that are taking advantage. But the SA Inc. shares are, besides the resource companies, are by and large selling to SA. I think if you look at the food space, it's quite interesting. So you've seen Rhodes Food Group and Tiger Brands reports in the last 2 days. And Rhodes Food Group has got a little bit of an export component. So dramatically different performances, the one maintaining the margin, the other one seeing the margin getting bludgeoned.
Can I jump in there for a second? I mean, it's not all fall down here. I mean, it sounds terrible, but there's companies like Super Group. I think they're going to shoot the lights out in this result now. They're benefiting from, obviously, like Peter said, on the coal distribution side, big volumes coming through there, and their local businesses, picking up market share. So what you're also seeing in the SA environment is strong balance sheets of strong listed players. You're picking up market share from the independents. Small businesses like Udaco, these conglomerate small businesses doing very well, supplying into a lot of these sectors. We had lunch with Renet on 2 days ago. That business is doing exceptionally well, supplying a lot of what we need in the South African environment, and obviously enjoying the benefit of better capacity going in through some of their divisions, etc. And obviously some of their older divisions, the old African cables, etc., which we know from 15 years ago, starting to obviously see the benefit of all this better generation coming through. So, I think there's opportunities. You just got to ensure that you find them, stick with them. I mean, we also like Grindrod. We think it's a great business. And then, there's still the likes of the Bidcorps, which is a global listed food distribution business. We still think Aspen is going to do well for us, over the next 2-3 years. It obviously sees capacity coming through, on the PE side, etc., etc. The local dollar-denominated businesses, the AECIs, the Omnias, these businesses will do well. And then some of our property counters, the NEPIs, the masses that have got, obviously, holdings offshore, see that translation effect. So it's not just the pure big Richemonts of the world, etc. So there's a lot of underlying companies that we think you can still make money out of. I don't think it's a complete all fall down scenario. I think you just got to be tactical. You've got to look for opportunity with big sell-offs like we've seen the last couple of days, weeks, and take advantage of businesses that we know are, number one, are not reliant on the electricity supply, and obviously you've got big diesel costs and are benefiting from the other side of this transformation we're going to see continue for the next 10 years.
Maybe one other thing to add to what Evan said is there's corporate action still out there. And if the action is not coming, you can try and motivate for it to happen. And in instances where, like a Northam, for example, they're sitting on 16 billion rands worth of Royal Bafokeng paper, they should actually shift that across to Implats. That should release 16 billion rand to Northam. Northern's best cash generative years have yet to happen still. It will happen over the next 2 to 3 years. So there's no need for them to sit on something like that. So there's relative value in Northern compared to, it's underperformed relative to its peers. So you find relative value. Another one is Fortress Bs. We've done phenomenally well on buying a mountain of Fortress Bs. Dysfunctional corporate structure with the A's and the Bs. It's upset a lot of A's, but the company is now de-REITed, so it's all about the NAV, not the yield anymore. So there are these types of opportunities. The Sea Harvest has got a dysfunctional shareholding structure. Peter spoke about exporters. We don't have an industrial base to export, but we've got one hell of a great fishing industry that's exporting extremely well. Oceana and Sea Harvest and I&J that sits in AVI. So let's not discard some of these companies with dysfunctional structures or management that needs or boards that need to actually take corporate action to unlock value. And if they don't do it themselves, we as shareholders have to motivate for it to happen. So there are these opportunities in the SA market still.
Okay, I see no one's jumped off the call and Eugene hasn't shouted at me yet. So Barry, Chris, if you guys want to have some closing remarks there.
Yeah, I think sort of echoing or reiterating what everyone's saying, I think in the South African market, there's probably two opportunities. You've got those sort of quality global consumer plays or rand hedges, and you've got these sort of smaller opportunistic self-help in some cases, or smaller industries in South Africa that are benefiting from the tailwinds in various sectors, or they've got very strong balance sheets where they can take market share from people that are over leveraged or just not positioned properly. So it feels a little bit early to just buy that general SA GDP play. So I think you want to play on those sort of sides. And I think as John Bickard said recently in an article, you buy when the lights are off and you sell when the lights come back on again. So it's time to start looking. I think he's sometimes a bit early, but I mean, he's got an amazing track record nevertheless. But I think we still have to start looking for those GDP players and have that hit list ready for when we see that total capitulation.
Thanks.
Yeah, just from my side, I mean, the one thing obviously watching is the Reg 28 changes that happened last year. So you are seeing this tilt from many of the balance managers selling down SA Inc., putting more of that money offshore. I think that is creating an opportunity in the small to mid cap space, especially when there's limited marginal buyers for these shares. So as the guys mentioned on the call, you've got to be quite selective in terms of picking the right business models and backing the right management teams, the companies that don't have bad balance sheets, because you don't want to get stuck with a value trap. But I think there's plenty of opportunity in that small to mid cap space for companies that alone are doing buybacks. So that also provides an underpin for the share, but also you're getting good disposals as well to unlock value. So I think the important thing is to back the right management team that actually creates value in this environment, opposed to doing empire building. So I think the clear example last year was what PSG did with the unbundling. We're likely to see further corporate activity on that side, whether it's unbundlings, M&A. I mean, there's lots of opportunity in the property space as well, where better quality guys are looking to take out smaller players at a selective asset basis. There's also some corporate activity as well in the listed space with Life Healthcare, for example. I mean, everybody knows that there's the AMG deal that's potentially on the card, so we're likely to see some announcement as well going forward over there. So I think back to first principles, backing the right management teams with a company with a good business model and strong balance sheet, because you don't want to be stuck in a value trap in a rising rate environment. I mean, there's many examples in the retail space, for example, where some of these balance sheets have become very stretched, very, very, very poor cash flow generation as well. And I think those are some of the traps that investors have got to watch in a market that's derated at aggregate level.
Guys, unfortunately, all good things must come to an end. Thank you very much for your time. Eugene, I'll hand it back to you.
Thanks, Brendan.
Thank you for making for great discussion on a very interesting panel indeed. And thank you to our panelists this morning, Evan, Barry, Chris, Patrice, and Peter. You really serve us well. And if I can maybe wrap up by stealing Evan's words, it's not all fall down, and there's clearly still some good opportunities out there. From my perspective, what is clear about these sessions is that you do need fund managers that are nimble enough to navigate these markets. And as Patrice said, sometimes you have to relook your views on how you look at stocks if the macro factors are becoming overwhelming, and our managers can do exactly that. Gentlemen, thank you so much for this morning. To our audience out there, quick reminder And back next week, Wednesday again, 7th of June with Methodical. Thank you all for joining. It's always great to have you with us. And thank you to the BCI team, Olga and Tanya, for your arrangements and making these sessions possible. Looking forward to seeing you next week, Wednesday, and keep well.
Thank you.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thanks, cheers.